Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello, welcome back to the Australian Retirement Podcast, your source of financial retirement goodness every Thursday. Drew Meredith is here with me as always. Hello, good sir. How are you, mate?
Such a pleasure to be here. Excited as always. I'm going to call this the Ninja Retirement Q&A, where we're going to throw questions at each other.
Yeah, we've decided that the Q&A is it's a little too easy when we know what's coming. So we're going to do this one a little bit differently. I've selected a couple of questions that I'm looking forward to heaving your way, and I'm just going to watch you squirm and struggle with the question on the spot. So yeah, this is going to be good, and I think between the two of us, we'll both struggle together.
Perfect, and make me sweat. I know you're always trying to give it a sweat. I'm only wearing one layer today, and I think it's incredibly important. Like this is why we do this podcast as well. So we've got hundreds of questions coming through. We love getting the questions. Love people listening, following, subscribing, and this makes sure that what we're talking about is what people actually want to hear, not just us going down different rabbit holes about retirement and superannuation. So, yeah, throw them at me.
All right. Yeah, I completely agreed, mate. Thank you to everyone who submitted questions, and we're doing our best to get through them. Is the best we can say here. So, number one question I've got is from someone called Little Rascal. Hello, Little Rascal. I am not in paid work, 54 years old, with an inheritance, but little super, under $150,000. I have an investment that is going to mature, and most of the interest will go in tax. Can super contributions help to reduce my tax?
It's kind of a difficult one here because it's hard to understand exactly what's happening. But what you're saying is that you're going to get a lump of income, and that's going to be part of your taxable income. So what I see this is a question about super contributions. And the most simple way to think about it is there's two types of super contributions: non-concessional, which are after tax, no tax deduction, and concessional contributions. So Little Rascal is asking about concessional contributions. And these days, you can actually make them from your own savings as well as via something like salary sacrifice or your super guarantee contributions. And he's not in paid work, so he would be able to make, I'm assuming Little Rascal is a I keep saying that you could make a concessional contribution being under 67 years of age and claim a tax deduction against your taxable income. But the big but here is it will reduce the tax. It will act as a tax deduction and reduce your taxable income in your own name. But when you make that contribution to superannuation, you will attract superannuation contributions tax at a rate of 15%. So it's not this completely tax-free decision that you make, that you are paying tax somewhere. So, and this is where quite a few people I think get caught up, which is if your taxable income is below the 15% tax rate, then there would be no benefit in doing this.
Yeah. Hey, firstly, well answered. You flew off that one.
Love super contributions, bread and butter.
That point that you made there at the end is the one that really stands out to mind, which is that you've said that you're not working, mate. And if you're not working, if your taxable income, including that interest that's likely to come through, if that's below $19,000 or $18,200, you're not paying any interest on that, or you're not paying any tax on that interest. It's already at 0% because you're not going to have the tax rate zero if your taxable income is below $18,200. Now, if your taxable income is above $18,200 because the interest is big enough that perhaps it's a higher number, or perhaps you've got other investment sources, other income. If it's below $45,000, then you're paying tax at 18%, including the Medicare levy, 16 plus 2. Now, in that scenario, 15% into the super fund versus 18% in your own name. He's 54. Welcome your comments, but as a house rule, I'd forego 3% of income. Typically speaking, I'd forego 3% of income to have the money in my own of tax to have the money in my own pocket.
Yeah. Sure.
So unless there were, perhaps strategically, there are some other reasons to really be boosting your superannuation, but that's not the question that you're asking. If your taxable income's below 45K, then super contributions may help. They're not going to help enormously, even if you optimize them. You really have to have taxable income above 45K to start seeing some meaningful benefit from putting money into super. But the last thing, again, without knowing how big this inheritance is and how big this interest, the interest is the idea of carry forward contributions. If Little Rask was not in paid work, probably unlikely they've been making contributions up to the cap for many years. And of course, he's got 150K in super too. So that speaks to the idea that that's really, really unlikely. And so if your interest here were $150,000 and you're well and truly going to be paying tax, you could conceivably be putting in more than the $30,000 amount via a carry forward contribution, claiming a much bigger tax deduction. That could be on the cards for you. Yeah,
for sure. And it's all about that arbitrage of tax rates, isn't it? As a rule of thumb, we kind of look for you want at least a 10% benefit by doing something. So a 3% benefit depending on what the amount of income isn't overly material. But if you're comparing like the 45% or the 30% tax rate to 15, then 100%, it becomes close to a no-brainer. Give or take that you can't access your super till at least 60. So we always have to weigh that up. And I can't pronounce the next questioner name.
That's a bad start for me.
Yeah, Frank. This is a question from Frankie Queditz, I believe. I'm guessing you were always good at the zeitgeist and understanding what niche references is coming to. I'm not sure if there is one in this case.
This one.
Yeah. I'll leave it to you then.
Yeah, this is Franking credits, right? Frankie Queditz.
Frankie. Oh, all right. See, I told you you're much better at this. Your perception is much better. Now, this one's about, again, about super contributions. So a big part of retirement is, when does it make sense for a higher paid spouse to start contribution splitting into the lower paid account? Ignoring, so a lower paid spouse's account, ignoring that it feels fairer to balance out things, our things anyway. So there's probably two questions here. Is what is contribution splitting? Really to grill you. And when's the best time to start?
Yeah. Okay. Well, hi, Frankie Queditz. Good question. Superannuation splitting is when you take the concessional contributions that have been made to your superannuation fund from the previous financial year, and you have the ability to elect to have that money paid into your spouse's superannuation. There's no tax consequence. So in real terms, practically, let's imagine for simplicity, last year, which is FY24, last year, the super contributions into my super fund were, let's say, $20,000. Now, there'd be 15% tax applied to that, which would bring it down to $17,000. And I would have the ability to split all of that $17,000, essentially transferring it out of my super fund and into my wife Louise's superannuation fund, again, without any tax consequence. My super fund goes down by 17. Her super fund goes up by 17. So one of the obvious things here, of course, is that one of the benefits is that you get to equalize your super, which can be quite helpful for a few different reasons. But you've specifically said excluding the feel good, we both had a similar super balance. So let's move that to the side. There are a couple of strategic reasons why you would contribution split if you are ignoring the evening a balance out for the sake of fairness. The first one is that you have a spouse who is significantly older than the other spouse, and we are looking to get money out of one spouse's name and into the other so that you can qualify for the age pension. So for simplicity, we've got a husband and wife, husband's 62, wife is 66. And husband's already had as much money possible transferred into his super via non-concessional contributions, etc. But when the wife turns 67, she would be eligible for a small amount of allocated pension, but she's not going to be eligible because her super balance is too high. The super splitting that you do in the lead up to her turning 67 might mean that her super balance is lower, so it's not accessible when we roll around to age 67. To rephrase, I'm sorry, his super balance is not accessible. Hers is, but the balance is lower. So that can sometimes create an age pension outcome that wasn't there before, or a superior age pension payment. That's
and all completely legal.
Yeah, very. Yeah. That's strategy number one. Strategy number 2 would be that you are trying to avoid the penalties that exist with either the transfer balance cap or whether, depending on how things unfold, the $3 million cap, which will come in the future. Now, if we've spoken about this on the podcast before, but if we go back to 2016, for example, regardless of how much superannuation you had in your super fund and indeed your pension, the tax rules were the same. It was 15% in accumulation and it was 0% in pension phase. And the government at the time introduced this scheme where they said, as of 1 July 2017, if you have a pension balance above $1.6 million, you will not have a tax-free pension anymore. So consider a scenario. Let's see, now those numbers have been indexed, but let's just ignore that and keep that really pure. If you had a scenario where someone's super balance was moving toward 1.6 million in their 50s and 60s, you could see that that's the trajectory it's on, and they've got a spouse with a very low super balance, then splitting all of their contributions throughout their 50s and 60s might keep them below 1.6 and keep their spouse below 1.6. And then in both cases, there's no concern around paying additional superannuation tax. Yeah. Now, again, let's ignore indexation. Those numbers have gone up then. It's currently 1.9, but regardless, that's the concept here. If you look at it from a current legislative perspective, or as I think about it, the obvious one is, all right, well, the modelling shows that I'm clearly going headfirst into that balance of over 1.9, that transfer balance cap figure, so we run into a problem there. But I'm a little bit less trusting of where we're going to be and where that tax legislation is going to move in the future. My intuition is that pension, if by the time that I am a retiree, that 1.9 is not going to be 1.9 anymore. It's going to be $1 million or a lower figure altogether, and 0% pensions will be close to a thing of the past. If that's going to happen, my intuition is rather than just aggressively changing that for everyone, they're going to gradually reduce that limit over time. And so with that in mind, even if you are looking at saying, well, I'm looking at going into the $1 to $1.5 million balance by the time that I retire, and my spouse has a $0 superannuation balance, equalizing that is protecting against future legislation that might change and seek to tighten those figures.
Yeah, for sure. And the only thing I'd add is that it's probably not as impactful for contribution splitting because it's only your concessional. But as you were saying, getting more money out of the older spouse's name, you can actually do the opposite when you're getting closer to 60, put more money into the older spouse's name because they'll be able to access it sooner. So if there's a significant age difference and one person's about to retire, you get more access to that super and help you fund that transition to retirement. But so much of it comes down to age and that I keep saying arbitrage, whether it's arbitrage of tax rates or it's arbitrage of conditions of release.
Yep. Yeah, perfect. Okay. All right. Let me find a tough one for you. I was looking through these before and there's some questions here. I'm like, it's too easy. I want to find one that
bread and butter.
It's hard for you. Here we go. Here's a good one. You feast yourself on this one, sir.
All right.
This is from Mrs. Analysis Paralysis.
Good name.
Yeah. And I can understand why, based on the details she's got here. So our is approaching 1.9 million per person. And we've just sold a business with a value of $380,000 with another similar amount coming later this year. There's no CGT on the business because they took advantage of the small business CGT concessions. Cool, good job. We are well set up outside of super with no debt. I appreciate some info on the pros and cons of investing this money within super or outside of super. Thanks, guys. Love the podcast. And if Drew has any copies of the golden years floating around, I'd love one. So let's start with the most important part of this, Drew. Do you have any copies of the golden years floating around?
I have 3 boxes under my desk. So,
all right.
Yes, Mrs. Analysis Paralysis, please send through your address and I will get a book, maybe 2 books out to you as soon as
fine book. Come on.
I possibly can.
Okay. So now that we've dealt with the most pressing issue, they're at 1.9 million. They're at that point whereby it's very likely they're not going to have a tax-free pension. They seem pretty well set up outside of super, so presumably they're paying some tax in their own names. They're likely to in the future. What do you reckon? What are you doing?
Yeah, there's a bit of complexity here too. So my first thought is at small business, you got the small business concessions. Are you using the CGT contribution cap that comes, the exempt CGT contribution cap, which lets you put in, I think these days, I haven't seen it for a while, like up to 1.7 million over your lifetime, and it's $3 million cap aside. The more you can get into superannuation, the better. So that'd be the first part, and that kind of links to the real question is why would you invest it? I assume this is contribute and invest it inside or outside super. And you can start with the reasons why you wouldn't, particularly in this case. At this point, they're 57. You have to understand what cash flow, what assets they have outside super, and whether they have the ability, whether they have income to fund their lifestyle until they can access their super at a minimum of 60. So the first one is that your money is locked. It's preserved. It's subject to condition of release. So that's the big question. Do you need money to fund your lifestyle, or can it just be dumped into super? Investing outside super gives you more flexibility. You can sell it any time. You can spend it tomorrow. You don't have to meet any additional same kind of angle as that. The challenge of that, of course, is marginal tax rates. You paid off your debt. You've sold your business. If you're investing outside, you're going to be subject to, if your income's over 18,000, you're going to be paying tax at the same rate as you would in superannuation. If it's even higher than that, which is likely the case, then you're going to be paying a higher tax rate. And I think the big question is all about flexibility, because we know the benefits of super. One, you can get that money into super tax free. You're never going to get, if you already met the $1 million caps, this is your only chance to get more money into super via the CGT rollover. And when you commence a pension, even if it is just from your 1.9 million, that's going to be up to 1.9 is going to be tax free. And the remainder's at worst at the moment going to be taxed at 15. And then a portion of that potentially at 15, if that $3 million cap comes through. I think essentially by putting it in super, you're allowing more chance of compounding and compounding at a higher rate because you're likely to be paying a lower tax rate. And I mean, it's kind of the basic pros and cons of investing inside and out. I see them as exactly the same thing. You can hold the same investments. You're likely in a self-managed super fund. There's no difference or restrictions on what you can hold outside of residential property. So it's more about the after-tax outcome and the flexibility you have.
I think you answered that question annoyingly well, mate.
I'll take that.
Yeah, well played. Well played. Now, you were saying that you had a nice simple one for me.
Oh, this one is incredibly challenging. I'm just reading through it at the moment. I've actually worked through this situation with several clients before, and it's actually more common than you think. So this comes from Rascally Rabbit. I know this reference for once. I'm hoping it's Bugs Bunny.
Kind of thought, isn't it?
Yeah, this one's referring to the old downsizer, or let's call it, started off as downsizer. But Rascally Rabbit asks, partner and I are probably retiring in the next 3 years, aged early 60s, have reasonable assets and own PPR, would like to move closer to city from suburbs, but will probably not have enough to buy a small house in a city and make downsizer contributions. So that immediately makes me think, is this an upsizer? We don't talk about upsizers enough. Mm-hmm. Have the idea to maybe do joint ownership of the home with our 2 adult children, paying 1/4 each, so they'll only have to pay half the cost. And this is a multi-layered question.
Yeah, I'm getting that sense.
Would that structure allow them to use their portions under investment property rules, or would they need to jointly own the whole property and we be their tenants? Thank you for everything you do, James. I get so much from your podcast. I'm assuming it's for both of us. Yeah. So the question here is I think a good one to look at would be upsizer. You know, what should people consider if they want to spend more money on a house than the one they're selling? And the second one is probably filtering into tax agent area. But what do you need to consider if you're involving children in your investments or in property ownership? So over to you with this incredibly simple question.
Yeah, well played. That's left. Okay, and thanks very much for a great question.
I know how I'd answer it, but no pressure.
That's all right. I think I've got this. I think I'll do my best to ask it. So firstly, if there's no downsizer available, then maybe this is an upsizer, which means that your all-in costs for where you would go if you were to move into the city are going to be higher than the benefit or the proceeds you're going to get from selling your current home. That can be okay in retirement. The critical thing that we would look at simply is what's going to be left after you have made that transaction, how much is going to be left in your net assets, and can you confidently self-fund from that point onward. A lot of people, it's not uncommon to upsize as you approach retirement. Sometimes it can be saying, for example, we've had the family home that's been in the outer suburbs, and it's all about quality of life now. We want to be in a really beautiful home in the city or inner suburbs, which I presume is the go here. You may also want to consider, you might be looking at this with the lens of saying, well, we can't afford the upsize. Maybe you can if you consider that even this asset itself is going to be sold, and that will necessitate a downsize in the future.
I think that's the key one there, that you're not making, this isn't a decision
a
made
lifelong upsize.
By itself. You will change again.
So we've done this for members recently. Well, I say recently, more than 12 months ago, as I think about it, where we ascertained that they could upsize, but they needed to walk into the upsize with the expectation that within a decade they would need to downsize.
Yeah.
And the downside, best guess is, based on current markets, you'd be downsizing to this kind of asset. And they were comfortable with that and said, for the next decade, we really just want to enjoy our retirement as much as possible. That's the focus. And so in that case, it worked for them.
That's kind of the difference between investable versus lifestyle assets, isn't it?
Yeah. I find, luckily, it's a pretty pure discussion in the sense that it's true that different assets will change in value. And for example, if depending on what you're buying, if you could have a scenario where the next asset that you want to buy grows at a different pace. But as long as you don't hypothetically make the mistake of investing in a relatively uncorrelated asset like a big penthouse flat in Elwood, and then we're going to downsize to a townhouse or a home in Richmond, those things are going to grow differently over the next 10 years and might not be in your favor. But assuming that you're going to a house, a big, like your upsize house, and then we're going to downsize to another house, it's very likely that whatever happens in one asset is going to happen mostly to the other two. So you're pretty well insulated regardless of what happens in the market. What else was there? The home ownership and doing it. Okay. So tax, firstly, your children you're allowed to rent out a property to anyone, assuming that you don't own it through a self-managed superannuation fund. So, and you can get the tax benefits for that as long as you can demonstrate that the nexus of the investment was for income-producing purposes. So, there's nothing primarily stopping your children from claiming a tax deduction on a loan that they have for any property, whether you live in it or anyone else does, on the proviso that they are receiving income from the property and there's no discounting associated with that arrangement. So if we practically think about what this might look like, and again, we'll just use some really simple numbers. Let's imagine market rent for a property like this might be $4,000 a month, and they were going to own 50% of that. The expectation would be from the ATO would be that they would need to be receiving at least $2,000 a month or $2,000 a month in line with their 50% ownership.
Yeah.
My limited understanding on this is that if they were to discount that number from $1,500 a month from $2,000 a month to say $1,500 a month, which would be a 25% discount of the rent that they're entitled to, commensurately, the tax deduction would also reduce by 25%, on the loan. Although that, I must confess, that's getting to some complex accounting.
Tax agent questions.
Yeah. Having said all of that, there is a bigger piece of the puzzle for me, which is the idea of buying a home, which is obviously a long-term asset, and buying it in a multi-generational arrangement. And that always makes me feel uncomfortable when I look at these. Without knowing what your children's circumstances are and where they're headed, what their incomes are, what their family situation is, life is uncertain and life moves. And over a 10+ year period, for example, this new risk appears that their circumstances could change to an extent whereby suddenly there's this huge amount of pressure, which you don't want to be carrying in your retirement around how we're going to maintain this home arrangement that we have right now. And also, it can also hamstring your children in the sense that as their lives develop, they are thinking to themselves, you know what, honey, it really would be time for us. We'd love to go and get a bigger place and the kids have a big backyard and all those sorts of things. We'd love to do that, but we can't because we'd have to sell that asset and mum and dad live in it. So we can't do that. It's clunky and it's messy, and I think you should avoid it at all costs as a house rule.
I think
even if you've got a great relationship, the nature of people's lives is that things change, and it's a big burden, or it can create big burdens for some or everyone in the family.
I think the less complexity, the better in these situations. And then I've helped clients with quite a few upsizes, and I think the key here is having your eyes open, and that's why advice can be valuable, which is you're basically pivoting moving a portion of your investable assets, which are there to generate an income, into lifestyle assets, which aren't generating an income. You have to be comfortable and prepared for the fact that your investable assets are going to reduce more quickly because they're less. And as you said, at some point, you're going to have to convert those lifestyle assets back into investable because you can't sell a bathroom in most cases anyway.
Yeah.
But I thought you answered that incredibly well, better than I ever would. So congrats on that little that curly one.
Thank you. I'd also add that the one benefit of the ownership structure that they're proposing is maybe they could sell the bathroom. They could say, look, that's 8% of the house. You can take a 58% position in this house. Unit trust.
Yeah, unit trust it. Yeah. Brick by brick.
All right. Bali Bintang. Hello, Bali Bintang. Thank you very much for asking a great question here. I'm 50. Wife is 48. My wife works casually, earning under $30,000. I earn nearly 200. My last child finished school in 2024. Mortgage only debt and pay double on this. So I think what's being said, I only have a mortgage and I'm paying that at double rate.
Paying it off, yeah.
We now have some extra cash. I've been salary sacrificing into my super to the maximum for the last few years. Ideally, I think my wife's pay could go into her super, but understandably, she wants to feel she has money even though all her accounts are shared. Sure. So this year we have started buying it says EFTs, ETFs, I presume is the reference. Yep. My question, from our bank accounts, should we pay max caps into her super, doing it on a fortnightly basis? And then what's left, we keep buying ETFs. Thank you in advance.
Yeah, I think first one is well done. Like, you're in a strong position. You're paying off your mortgage aggressively. And I think the big part of the answer to this question comes down to psychology. Like, I completely get that it's kind of almost the independence that comes from having your own salary and income showing up. I completely get that. And you might be sharing bank accounts, but it doesn't necessarily, if all your money is being directed straight into your super fund, then it feels like you don't have any. And that's understandable and happens consistently. And it's probably an extension of the retirement and superannuation sector in Australia. I'll have a crack here, which is that most people don't really feel like their superannuation is theirs. If you felt like it was yours and you had some input and transparency and control, you might feel more comfortable putting that money straight into superannuation because the tax benefits are clear and it's something important to do. I think, but the question is really from our bank accounts, should we pay maximum amounts into super? The first consideration would be, are you better off paying off even more against your mortgage at the moment or holding it into an offset account before you think about that? And the second one is, your wife's 48, 12 years until she turns 60, at which point will be the first point she'll be able to access superannuation. So how much mortgage is left? Can you more aggressively pay it off with those funds, or can they just be held in an offset account and get the best possible outcome? And I see kind of a second angle on this, which is the idea that you don't necessarily have to pay your super contributions from your own bank account or from your own money, if that makes sense. If these funds are held in a joint bank account, psychologically, it can feel like you're both, or the husband is paying for it, but it's included in her tax return and it's going into her superannuation fund. That's the kind of psychological money point of view, which is almost tricking yourself. The outcome's the same. It's still going to the same place, but it feels completely different.
Yep. Yeah, cool. I've got a couple of cents to throw in here, and it's just around the wording.
They've been a bit
I'm
twisty,
looking at the
these
question, which is an unfair advantage. But it says, my question, from our bank accounts, can we / should we pay max cap into her super? So if we just emphasize that maximum cap piece, the answer to that is no.
No, the tax benefit's not there.
That's right. So it says that your wife's earning under $30,000. For the simplicity of this conversation, let's assume it was 30 because it's a nice, neat number. Earlier in this episode, we talked about that figure of 18,200. If you're earning under 18,200 taxable income, you pay no tax. So if you max cap, as a reminder, the maximum contribution cap is 30,000. Presumably, we're talking about concessional contributions here.
Yeah.
So if you have $18,200 of taxable income, putting money into super as a concessional contribution is wrong, because you're paying 15% into the super fund, or 15% tax to get the money into the super fund, whereas you could accept the money as cash into your own name, paying 0% tax, and then make a non-concessional contribution into the super fund, which would be also at 0% tax. So if her income were $30,000 neat, and you wanted to get as much money into super as possible, even if you said we're hell-bent on getting $30,000 a year in, ignoring all other deductions, you would be better making taxably, you'd be better making $18,000 or $11,800 for concessional contributions, which would bring you right down to the 18.2. Take all the rest as income, tax-free 18,200 income, and then put that only 200 in as a non-concessional contribution. That's the optimal tax outcome.
Well answered.
I like this question in the sense that just the way that this is phrased, it's cool that it seems like you guys are very much on the same page, and it seems like there's a good level of understanding in terms of how you're both feeling about this. I think that's really, really healthy. So great question, and seems like some good underlying things here too. So it warms the cockles of my heart.
And I think this next question, it's. I think we couldn't have popped out some of the most difficult questions we've ever seen. And interesting, no name. This one comes from No Name. And I'm going to ask you to keep the answer short.
I saw this one and I didn't want to give it to you. So this is hostile.
I was happy to pop this one in. Hi, Brains Trust. Question around a GFC 6 months into retirement. And I'll be honest, my family invested 6 months before the GFC hit, so I've been through this before. It's not my question, though. I'm guessing, like me, most people are in an industry super fund and have not or will not ever see a financial advisor. Now, we definitely hope that's not the case. Looking, just because you're in an industry fund doesn't mean you can't benefit from advice, but I'm answering the question for you. Looking to retire in the next 10 years, around 60 years old. Currently, it's fair to say super and the share market are performing well and financial life is good.
Good.
If your super balance is above 1 million, which means no age pension, what are the ways to mitigate losing money during a GFC situation shortly after or during retiring? Understanding we are obligated to continue drawing down the minimum super balance even if it's dropped 30%. So it's the second part of the question. As a true Australian, when maybe we don't need to include this, when I finally leave my place of employment, I will most likely burn every bridge on the way and tell my employer my true feelings about the job. So no going back. What would be some, essentially, let's just get away from the...
what would be some strategies? To burn every bridge? I'm confused.
The key here is, so what are some strategies to mitigate the impact of a significant, we're talking about longevity risk here. How do you make sure your superannuation or your assets outlast you rather than you running out before, running out of assets before you pass? So what are some strategies we can use? Will an annuity protect me? Should I have how many years of income should I have put away? And that we don't have to go into that. It's a bit too specific. Would an investment property protect me? And then I think we can avoid the last one, which should I invest some money outside of super in a brokerage account to buy the downtrend when it happens? So these are getting very specific, but I really feel like the high level question here is what should retirees? You read any news article, you read headlines all the time, and it's always talking about a crash. Valuations are too high. I can't tell you how many times I have that conversation. How do you protect yourself and your retirement so that if something bad happens in the market, tends to drop 25 to 30% once every 10 years, how how do you make sure you're not going to impact on your lifestyle? It doesn't need to change.
Yeah.
Can't be crypto.
Hello, no name. And thank you for submitting your question, man. Okay, so I'll take it from the top and just compartmentalize it. So you're currently 50 or thereabouts. Yeah, you're right. Super and share markets are performing well. Financial life is good. If your super balance is above $1 million, there are definitely some ways that you can mitigate losing money during a GFC shortly after during retirement. When you're in retirement, like if we all think about our retirement years, and hopefully they are self-funded years, you are going to have share market crashes. We all are. And now when that happens is going to vary. But if we think about the big crashes that have happened that have wiped in excess of 20% off markets, most recently we had COVID-19. Before that we had, there was the GFC, but in between that sub 20%, there was the pigs crash, Portugal, Ireland, Greece, Spain, the European debt crisis.
I forgot about the pigs.
Yeah, I forgot about that one. We had the dot-com crash. We had 87, dot-com being 2001. So this is common. We're going back 7 to 10 years or thereabouts, and there are these events that are consistent.
And you'll never see it coming, and no one will ever predict it.
Yeah, we're thinking about someone's self-funded retirement. This isn't what happens if this happens. It's how do I manage the fact that this will happen in my retirement? These events are going to happen, and we should be thinking about our retirement funding from that lens. The first thing is that leaving more money in retirement makes sense. We don't have, or in your retirement assets, in your pension funds, for example. If you were to take money out of your pension, sit it on the sidelines to protect yourself in case there was a crash so you don't need to withdraw the balance, the lifetime cost of having that money sitting on the sidelines versus the true cost that you pay of having that money also exposed to volatile markets at the time, you're going to be much better just continuing to be invested. If we look at, for example, $1 million benefit and what would happen if the market has dropped by 30%, well, of course, as a retiree, we should just be looking at, in my mind's eye, we should be looking at changing your allocation to have less exposure to these markets. And what that means traditionally is reducing your exposure to growth assets and increasing your exposure to defensive assets. We have very, very few retirees or retiree members, even very close to retiring members, that have money invested in high growth or growth. It's growth, or it's moderate, or it's conservative, because we are trying to limit the level of exposure that can happen at the time. So if we think about a conservative risk profile, for example, which would be a wonderful outcome if you could still self-fund. During a GFC, those sorts of positions were falling by 10%, despite the fact that the market fell by 40-45% over that same time frame. And it's because they're less exposed. Now, the trade-off by reducing your exposure there when you're in retirement is that you are getting less return. And so the thing that stands out to me is, what level of I'm about to retire, what level of return do I need to confidently be able to achieve my retirement goals? That can be determined, by the way, with the help of a financial planner, but if you don't ever want to see one, then that's on you. What level do I need? And then if I need that level of return, what does that mean in terms of volatility? When the market event rolls through, what's that going to do to my portfolio? And in our team, we try to be really explicit about that for retirees, to set that expectation that sometime in the next decade, you will have an event which is going to, if we left it unchanged and we did nothing and we just said, just stay the course the whole time, we would see a portfolio reduction here of perhaps 15 to 20% in your situation, or 5 to 10%, or whatever the number is going to be for them. So the way that you offset this, first and foremost, is by having the right allocation to growth and defensive assets and not taking any more risk than you need to.
I think one of the keys here is that, and what I've found, I actually just came up with this, is that it's not that the market falls 30%. It's how you react to what the market does that ultimately determines the damage. We know over the long term, shares and companies are going to keep evolving, and then they've consistently recovered from any crisis. But we know that for people, and it doesn't matter whether you're in an industry fund or in managing your own money, if you make the decision to swap investment options at the bottom not anywhere near the bottom after the market's fallen, you're crystallizing and you're very unlikely to ever go back into the option that you had before. And if you looked at what happened during the GFC, the turnaround, and every crisis, the turnaround, if you just held on to what you were doing, was half the time, even less. It could be, and some people have never recovered because they made the decision to sell. And it's completely natural. The amount of phone calls we had, I remember a client who wasn't even a client yet. They had an industry fund. They said, well, I want to swap it in the pandemic. I want to swap it from growth to conservative because I need to protect what I have left. We're like, that is the worst decision you could possibly make. And they did it. We managed a portion that didn't change. They managed that portion. And that has never caught up to the portion we were managing. So it's how you react to that. And for us, it's how do we help with that? Well, it's all about how do we build resilience into your portfolio. So you've got a finite pool of capital, which means you need to balance exactly what you said, defensive and growth, and make sure you're comfortable. And that resilience comes, hopefully the reflection of that is that you feel comfortable with what you've got, and importantly, the amount of cash you have to manage the next few years during these periods, that you don't feel like you need to sell and protect your assets. And this is probably one of the one of the more qualitative parts of financial advice that you can't really you put into dollars the benefit that an advisor can have, but simply making sure you don't sell during those periods.
Completely agree.
The most value any ever added. I know a lot of our clients are still happy about that.
Yeah, it's funny you mentioned that, because that's I talked before about setting expectations with our members and retiring members around the likelihood that the hub falls and when it happens. One of the reasons that we're so committed to doing that is because, and you too, we've firsthand, we've walked clients through these events. And if you've taken the time to, whether it's set expectations or as an investor, if you're listening to this, if you understand that, okay, this type of portfolio is going to do this during a big market downturn. So eventually, like there's one coming, that it is going to come. It is so much easier psychologically to manage those expectations when we can say, well, we always knew that this was a matter of time, and we're here.
Yeah, exactly. And again, it doesn't matter where you're invested. You're going to be impacted, and these things will happen. It's about understanding, building a philosophy, building a framework, and if that's one thing we leave with, I think that's incredibly valuable.
40 minutes, mate. Good session, and I must confess, this was a lot harder than I thought it would be.
Incredibly difficult questions. We covered everything.
But a little bit of fun too. Again, for those of you that are submitting questions, we do get a lot of questions, and we are incredibly grateful to receive them, because it makes for a high quality show, and it makes sure that we are addressing the things that you guys care about. So Drew, I'm going to hand pass this one over to you, mate. If there's anything that you would like to say before we conclude.
Yeah, so for anyone who listens to the Australian Investors podcast, one of the most listened part of that podcast is my dad joke that comes out apparently, just self-promotion. And I thought this one's a little bit niche, but for those Star Wars fans, they might enjoy it. And I'm trying to keep it to the retirement theme. So we're going to leave you with a dad joke, and that is, what do you call a Sith Lord with achy joints?
Yep.
Darthritis. I always get in trouble for laughing at my own jokes, but I thought that was a good one. I know you're a Star Wars fan.
No, I'm over the moon that we're concluding now. I love it, mate. Thank you very much for a great show, and to everyone again, please keep those questions coming in. We're loving the opportunity to answer those. Thank you to everyone for dialing in, and we will be on your airwaves next Thursday.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.